Join us now.
I just think it matters.
Glad to be here, Julian.
In different people. That's the point.
Yeah,
different
symptoms.
symptoms.
You came in studio today.
Julian. Oh, I'm going to sneeze.
Don't.
Julian Emanuel, Evercore ISI Chief Equity Derivatives and Quantitative Strategist is here. And Julian, I'm with you 100%. This whole AI, I don't know what it is yet, but it's something. It's still good. Still, I mean, there's so much capital being deployed and it's got its tentacles everywhere, and it is amazing, but it's feeling, I don't know. It's
Nick's over there using hand sanitizer right now.
Yeah, but it's feeling kind of late 90s like, or is it not?
It's starting to. First thing I have to say is I'm glad as the guest I'm sitting wide angle.
That's not far enough.
At the desk.
You know how, when someone sneezes, do you know how far it goes?
Sneeze.
So much power in a sneeze. All right, go ahead.
So in our mind, there are a couple of actually key differences which make us optimistic that, you know, you're going to keep going, powering through into 2026. Is that what you've seen in 2025 is moving to the next level where companies across industries are actually talking about how AI is driving revenue. That was the sort of the solve that we needed to get further momentum behind the trade. And frankly, the other part of it is, unlike the 90s, is that the majority of the CapEx is being deployed by companies that have massive amounts of cash and massive amounts of earnings. And then the last thing for us is that when you look at the 90s, the trajectory of the indexes are quite similar, but actually the market internals were much more defensive in the late 1990s. It was essentially all tech all the time for the last 2 years. You look at advanced declines in this bull market, they don't capture the headlines, but the vast majority of stocks are rising as well.
Does for AI, does the level of interest rates matter in terms of, I don't know, does it need multiple expansion to keep going? I don't think it really, it's on its own.
It doesn't necessarily need multiple expansion, but again, this whole idea of the CapEx, and I think part of the indigestion that we've seen over the last week is companies that are going to have to raise debt to finance more CapEx. That's where you do need interest rates to be subdued.
Okay, before I talk about interest rates, the rest of the companies in the United States, there are others. We've been hearing recently that earnings look good for this year and next year, so that you wouldn't need the multiple to expand to still have some gains in the market.
Yeah, from our point of view, look, we think, as is typical, that bottoms-up consensus of around 13% earnings growth is too aggressive. It almost always is. We think high single digits for next year, and it's doable. And if you think about it again, the genius of corporate America in adapting to tariffs, in starting to deploy AI, means that margins stay elevated, and that's part of the calculus that gets you to higher stock prices next year.
Okay, let's talk then interest rates. I thought it was interesting. I don't know whether this gentleman's right, Stephen Myron, who's got a couple of jobs now, or at least he could go back to another one. But he's in the Trump administration, so he's on the same page. He says that some of the policies in the Trump administration in terms of productivity enhancements and deregulation, that interest rates can actually be lower and still keep inflation under check. And so they're too high right now.
Well, look, so our view at Evercore is you're going to get 2 more cuts this year and probably 2 or 3 next year. And frankly, when you think about the momentum in terms of earnings and the fact that I think we have to face it is that inflation is closer to 3% than it is to the Fed's stated goal of 2%, that argues that the rate path should probably be gradual as the market's pricing in now. But certainly there is room for rates to go down.
So people say de facto that the goalpost has moved because we're not getting to 2% till 2028 or 2029. So if you're cutting, what do you say, 5 more times? 5 more cuts into a 3% inflation rate means that you're really not serious about it.
So if you look at the last couple of years, Joe, the important thing is not where the level of growth is or where the level of inflation is. It's the direction of travel. Okay, because remember, a couple of years ago, we were looking at 9% inflation for a spell, 8-9%, and that started coming down. And here, the critical thing is we still feel like there's another quarter or two of digestion of tariffs and of policies before inflation starts moving down again. But it is going to move down, and that's the critical issue.